Uncle Sam always wants theirs, but what about us? We're the ones earning the money, we're the ones working hard. What can we do to help shelter ourselves, keep more of our hard-earned money? In today's episode, we're going to take a look at 8 things you can do to take a bite out of the capital gains tax. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now, like this video, and tap the bell icon to get notified of the next one. Thank you. Okay team, let's take a closer look at this and let's go ahead and get the elephant out of the room by identifying the worst and most painful part of the realities of capital gains tax. So the IRS generally levies a capital gains tax of up to 15% depending on your tax bracket on the profitable sale of an investment property. So when it comes time to sell your property, just be prepared for that unless you're using one of these 8 strategies. Now the best thing that you can do is talk it over with your tax accountant or tax attorney, financial planner, whoever that you have on your side that's trying to help you reduce your tax liability. It's important to note that personal residents normally enjoy some tax havens. Now you may already know this. You can save up to $250,000 in capital gains tax if you're single, or up to $500,000 of capital gains tax when selling a property if married filing jointly. It's not the case with your investment property most of the time. Obviously that exclusion is worth a huge amount of money and it comes with a lot of tax savings for you if that's your case. So let's take a closer look at this and put this into some quantifiable numbers just to let you know how much we're really looking at here. So assuming the long-term tax rate of about 15% on capital gains tax, that adds up to as much as $37,500 for single owners and double that for married owners, of which you can expect when you sell a property. So it's important to note what we're really looking at. This is something that you can use to talk it over with your tax accountant, your attorney, or your financial planner, because $37,500 is nothing to laugh at. That's a lot of money. So the first thing that you want to do is know the capital gains tax rules. The good news is your investment property is not necessarily forever doomed to the capital gains tax rules falling into that abyss. It really depends on what you're looking at. You can convert the property status from an investment property to a personal residence by satisfying the IRS's simple use test. The simple use test would be to claim the exemption. You must have lived in the property for 2 of the most recent 5 years. So this is obviously one of the simplest ways to avoid capital gains tax, especially if you had lived in it for the 2 years and maybe you rented it out for year 3, 4, and 5 and then you got ready to sell it at 5. So long as it's sold before year 5, you'd be able to possibly save a lot of money here by getting it excluded from the capital gains tax rule. Again, something to chat over with your tax accountant or your tax attorney. The second thing you can do is use a 1031 tax exchange. Since the dawn of the Republic, Congress has had a landed gentry, so it's not so surprising that we would see landlord-friendly laws written into the tax code. Congress has even given real estate investors a gift not normally accessible to retail investors in stocks, bonds, and mutual funds. It's the deferral of the capital gains tax on exchanges of one property of a like-in-kind nature to another. For example, you can sell a residential rental property and buy a new one under the 1031 tax exchange so long as they're like in kind. To qualify, the property that you're selling and the property that you're buying must be, again, like in kind. Notice I said that a few times now. It's really important to get right on a 1031 tax exchange. They don't have to be identical. They just have to be within the United States and serving roughly the same function, if not approximately the same function. So in other words, rental property for rental property, like in kind within the United States, should qualify for the 1031 tax exchange. Talk it over with your tax accountant to learn more about how this works and how it actually applies to the properties that you have in mind. The third thing to know is what qualifies for capital gains tax deferral underneath the Section 1031 tax exchange. Now, obviously, there's going to be rules of this game, right? So let's identify those rules. The 2 properties don't have to change hands at the exact same time. Whenever you're selling one property to buy a new one, it doesn't have to be at the exact same time as would be the case with, let's say, a direct swap. At least that's what the IRS is looking at there, and that's the way they define it. So instead, with the deferred exchange, the disposition of the relinquished property and the acquisition of the replacement property must be mutually dependent parts on an integrated transaction constituting an exchange of the property. Another fact here is that you can't defer capital gains in personal residence under a Section 1031. Both of the properties have to be business investment properties. So your rental properties, whatever you're doing with your investment properties, they have to be like in kind and they have to be business investment properties. You cannot use your vacation home and you cannot use your personal residence to count on a 1031 tax exchange. So with this provision, keep in mind that it only defers the capital gains on one property. Your tax basis in the old property transfers to the new one. It's important to note here that a Section 1031 tax exchange only applies to the property itself. If you own the property within, let's say, a partnership, you cannot sell your interest in the partnership to just avoid the capital gains tax. It's something to be real about, and it's a conversation to have with any of your business partners that you may be purchasing real estate investment properties with. It's really important to note that just by simply selling your interest in the property doesn't necessarily exclude you from a capital gains tax. So you might be wondering, how long do you have to execute a 1031 deferred like-in-kind tax exchange, right? So let's take a closer look at this, because there are 2 time limits that you need to worry about. One of which is getting with your intermediary within 45 days of selling the old property and identifying in writing the property that you intend to purchase. Again, it's very important to work very closely with the intermediary, and you only have 45 days to identify the new property. The intermediary's job here is to ensure that the 1031 tax exchange actually is realized and happens for you. It's important to note here that the IRS does say that simply providing a written notice to your attorney, your real estate agent, accountant, or similar parties that might be acting on your interest as your agent are not sufficient. So make sure that you're working very closely with your intermediary to make sure this happens for you, okay? The second timeline we need to cover is the fact that you have 180 days from the time that you sold the property to acquire your new property, unless and until the due date of your income tax return is due, including all extensions. So if you did an extension to October 15th and you didn't start this process until September, this could be a little bit tricky for you, right? Plan this out correctly and make sure that you're timing this out right in a way that's going to make sense for your taxes and make sense for you. It's important to note that if you miss either deadline underneath this, then you're going to owe the capital gains tax. It's just that real, and it's just that simple. The IRS is not going to grant a waiver unless the president has declared the area that you're purchasing this property to be a natural disaster area. That's the only waiver the IRS is going to allow. Anything else? Too bad, so sad, you're going to pay the capital gains tax. So make sure that you're factoring in all this information when you're planning out your 1031 tax exchange to ensure its success and your success. By the way, if you don't have a tax accountant or tax attorney right now and you want to do some self-study, you can get more information about like-in-kind exchanges underneath Section 1031 of the tax code by looking at the IRS publication 544. I'll put the link down below for your convenience. The 5th tactic you can take is selling a losing property. Let's say that you do have investment property that you do want to sell, and it looks like you're going to generate a profit. So then you're potentially generating a capital gains tax liability along with that. Look at all the investment that you have and see if you've lost money on any of those investments. If you do have a losing property, then you might be able to offset some or all of your capital gains tax using a technique called tax loss harvesting. The link is down below for your reference to get more information on how that's going to apply and work for you. So essentially, the IRS aggregates all of your gains and losses for the entire year. So selling losers can help you lower your capital gains tax bill. And if you have excessive losses, then you can deduct up to $3,000 of your income and carry the loss forward every single year, deducting your loss against any capital gains, and then up to $3,000 of your ordinary income until your losses are exhausted. So you see, the deeper that we dive into this, a little bit more interesting it gets, the way that this tax code of ours really works. The 6th tactic is to ensure that you are timing your sell. If you're timing your sell correctly, what you want to do is you want to consider selling off your investment property when your income overall is low. Now you might be wondering, why do I want to do that? That's because the income tax rate used for the capital gains tax is a function of your tax bracket off of your primary income. So the lower your taxable income, the lower your long-term capital gains tax is likely to be. Again, check with your tax accountant, your tax attorney, or your financial planner on this to see how it's going to apply for you, and that you're timing this out correctly as it pertains to your income. The 7th tactic is to use a deferred sales trust. Now this could be helpful if you are unable to find a like-in-kind suitable property or execute the transaction in the time necessary to qualify for a Section 1031 tax exchange, or if you simply want to get out of your real estate holdings altogether, you might want to consider establishing a deferred sales trust, also known as a DST as an acronym. To help simplify this, what happens is when you get ready to sell this property, you set up the deferred sales trust. A buyer is going to purchase that property. As opposed to getting all your income at one time, the deferred sales trust is paying you an annuity. So the buyer essentially is funding that annuity that's held within the trust. The trust sends the income stream to you according to a schedule that suits your income needs at that time. That allows you to take your sales proceed in what's called an installment payment. The IRS deems that a structured sale underneath the Internal Revenue Code, Section 453. Again, of course, that link's going to be down below, so you're only going to pay the capital gains tax gradually as you receive the payments from the trust over time. Now, that's an interesting option if that's your situation. The 8th tactic is serving your patriotic duty. So what happens here is when you join the military, if you're called away on orders by Uncle Sam, the government says, hey, you got to go to combat, or you got to go here, or we're deploying you there, or wherever. Because as a former Marine, let me tell you, we go a lot of places, right? The IRS is going to see that you have orders, you're serving your patriotic duty, and call a timeout. When they call that timeout, it's for the IRS's use test of up to 10 years. Short of the 10-year limit, the IRS will not penalize members of the military for being called away from your home of record. That's what we call it, your primary residence, your home of record, on orders. It's important to note that if this provision does apply to you, it's pretty cool, but like everything else we've covered, of course, there's going to be a requirement. You would have had to live in the property for 2 years of the most recent 10 years for you to qualify for this provision. As a side note, you cannot use this provision more than once every 2 years. So obviously this is a lot of information about what you can do, and I hope it's giving you a lot of talking points for your tax accountant, your tax attorney, your financial planner, whomever you use. They are the gentlemen and ladies that are going to be able to give you the straight scoop, keep you current on the tax code, and help you plan out the best tax strategy for you when it comes time to pay Uncle Sam. Check out some of these other videos next about tax exemptions, property tax exemptions that might apply to you. Looking forward to our next conversation, and may your life be filled with love, wealth, abundance, and happiness. Talk to you soon.